Let's go. Okay, this is me. My name is Bas. I will be your host in the studio. Deepak, can you hear me? Check it. I'm using you as a test because you are active in chat. We have today Max right over there. We
Hi there.
also, hey Max. We also have Peter, who is with us from Rotterdam, the home office in Rotterdam. And I will be here presenting in The Hague. And on my table today are Philip
Hi, hello.
and Case. And we even have some more special guests here in studio as we have a real proper roundtable talk. So, 2022, a year in review. Let's see what we find. Because what a year it has been. The The layout will be that first we always need to set the scene. What are the international trends that we see in taxation? Or we zoom in. So, usually the big one in tax is corporate income tax. At least that's for most tax professionals what it feels like. It is really on a budget level. It's not a super significant one, but it is the tax to end all taxes. Do you agree?
Yeah, I do.
Most important one, huh? Or do you take other taxes as a starting point?
Yeah, I wouldn't say corporate income tax is the main player here, but there is a lot of fun development in wage tax as well.
Yeah.
And I'm sure our VAT expert would agree with you as well.
Okay. Okay. Well, it's funny you say this. So we look at corporate income tax first, and we see that this has been in steady decline. So where people are saying that there is a tax competition, I think this is very clear when you look at the corporate income tax, and the rates since the 1980s have been dropping steadily. Now, I know that not all countries, so I got these averages from an OECD website. And we see that it started in the 1980s with an average 40% tax rate. But as time progressed, we are now steady leveling out at around 22% as an average corporate income tax rate. So there is tax competition there. What else are we seeing? Over 2022, government spending has increased. So we see some data here that says that I think the trend line is slightly rising, but the government spending as a percentage of GDP is generally split around a 45% level, but has seen a sharp increase since 2020, which has a logical background, I would say, in the COVID crisis and COVID response. So I think we see here that governments need money because we see a definite spike. And so what do we look at? Well, always tax. And then what's there? So tax to GDP ratio, the trend line is upward. You see in developing economies that the percentage is lower. In the developed ones that they are higher. But the OECD average is steadily growing from 25 to about 36, 37%. So we're looking for revenue. Now, if we look at the OECD, and the OECD is not the only player here, but if we look at the OECD, then we see that this is the average source of revenue. So personal income tax, 24%, and social security contributions, 27%. So if we combine those, I calculate 51. So Richard, you may be right. You may be right. Corporate income tax may not actually be the most important tax. Maybe tax on work is the most important source of revenue. Is that something that you recognize?
Yeah, well, I do. Of course, it's part of the classic tax planning scheme to be active in corporate income tax. But yeah, this year we've seen a lot of major development in the personal and wage tax perspectives. So that's something I think that we can touch upon later. But definitely a big player in revenue stream of the government?
So we have a few other big players. We have value added tax at 20%, other consumption taxes at 12, property taxes at 6, and corporate income tax only 9. So it's very, very strange in a sense that we spend so much time in the tax industry focusing on corporate income tax, but perhaps that is because corporate income tax really affects the shareholder and the business case, because it is really a tax on a shareholder. Corporations themselves can hardly pay tax because they are a non-existing thing, and it's really a tax on the shareholder. Any corporate income tax means that the shareholders get less, and so the investment, the return on investment, the return on equity is lower. So in a sense, it only makes sense that it drops because countries are in competition. But if we combine what we see, we note that 51% on average of tax comes from work. And we also know that work has elasticity. Raise taxes on work too much and people stop working, especially if you're in a welfare state where the alternative is not uncomfortable per se. And so there is this background to taxation. Some taxes exist only for revenue diversification. And revenue diversification can be important because it means that in the so-called Laffer curve, which says that past a certain point, any percentage increase in a tax rate does not lead to additional revenue because the corresponding behavior drop, the behavior itself is more than 1%. And so you may pass a certain optimum. And by making sure that you have many taxes, no single tax needs to be too high. And I think this is a central theme to 2022 in tax. If I conclude this broad horizon, we say that CIT rates have been declining but are now steady. Tax to GDP rates increase. Taxes on work are always about 50% of revenue, so that's where we've hit a maximum. Labor has elasticity, so we don't want to go too high, but public expenditures grow, in part because of COVID response. And so therefore we need revenue diversification. What is a response from governments? International efforts to reduce CIT competition, international efforts to reduce CIT avoidance, looking at alternative sources of revenue, and rediscovering consumption taxes. And today, Max, how are you doing?
I'm doing great, thank you.
Yeah, you're doing great. You look great too.
Thank you. I must make a compliment for your boiler room setup there.
Thank you very much. We're talking about my fireplace.
That's also nice.
Bedankt. We are going to look to you to take us on a journey through, the pillars approach.
Yeah.
May I give you the floor?
Yeah. Don't know if you have some slides as well for me.
Yeah, I do. Look.
Oh, that looks nice. Yeah, two-pillar approach. So I think you touched upon two points which are relevant for the pillar 1 and 2 discussion, or pillar 1 or 2 part of this webinar, and that's tax competition and tax avoidance. Pillar 1 and 2 are in this year. It was agreement was reached within the EU. That pillar 2 will be implemented and will take effect next year, so 2024. So not next year, but the year after. And I think this pillar 1 and 2 will have a huge impact on tax competition and tax avoidance in the world. The background of pillar 1 and 2 is BEPS Action 1 report that was published in 2015. And since then, there were a lot of reports and lots of things to do about this report. And 2 pillars are identified as the 2 main problems for the next phase in world global taxation. The initial or current taxation legislation and what have you is based on brick and mortar companies, but nowadays we have digital companies which have a different approach to doing business and use different tools to that. Pillar 1 sees on the problem that companies can easily shift their profit base to other jurisdictions, such as by moving. Sorry, that's pillar 2. Pillar 1 is that it's very difficult for jurisdictions to tax digital companies. For example, Facebook is difficult to tax for jurisdictions because in many countries they don't have any physical presence. And for example, for France, that was a reason they want to tax also the digital type of companies. Pillar 2 sees on the shifting of profits to other jurisdictions by, for example, moving your IP to, let's say, a jurisdiction with very low tax rates, such as the Bahamas. That makes it easier for multinational companies to make royalty payments to those jurisdictions and lowering the taxable base here, for example, in Europe. Pillar 1 was more a project of Europe. So for especially France really wanted to some tools to tax Facebook, Google, and that type of companies. And Pillar 2 was more of a thing for the United States. The United States wants to tax its companies on a worldwide basis with a minimum tax rate, but many countries in Europe, such as Ireland and Hungary, have a very low tax rate, which is below 15%. So the EU didn't really want Pillar 2. Long story short, when the Biden administration took office, Biden agreed to Pillar 2 and also to Pillar 1. So in the last 2 years, there have been a lot of progress with implementing Pillar 1 and 2, of which the last accomplishment is that the EU will implement these rules. I don't know if we have the next slide as well. Yeah. So this is the timeline in a nutshell. We're now in 2022, of course, yeah, we can go to the next slide. So Pillar 1 and 2, the rules are very broad and can be very difficult to understand. But in short, Pillar 1 consists of amount A and amount B. Amount A allocates some profit derived in a certain jurisdiction where, for example, a digital company such as Facebook has users or makes use of some sort of services there. And Pillar 1 also consists of amount B, and amount B gives some extra rules to define baseline marketing and distribution activities in certain jurisdictions. Pillar 1 is in scope for companies if you have a worldwide turnover of 20 billion and a profitability of 10% or more. This is for amount A, and amount B will be in scope for all companies, regardless of your revenue. Pillar 2 is our rules which make it easier for jurisdictions to tax certain big companies which have many activities in different jurisdictions, but where the ETR, the effective tax rate, is in that jurisdiction below 15%. So it must ensure multinational enterprises have an effective tax rate of 15% on a worldwide basis. There are several rules to assign some profits from one jurisdiction to another, and it is expected that all countries will eventually implement these rules, but on an EU basis, it will now be implemented, and I think that other countries will follow suit, and that is especially because there's one rule which makes it possible for jurisdictions to tax companies located in a jurisdiction extra. And if you not implement that rule, that's called the qualified domestic minimum top tax. If you do not implement that, that's the third one. If you do not implement that rule as jurisdiction, other jurisdictions can tax the top-up tax in your jurisdiction in their own jurisdiction. So if we look to the public consultation document the Netherlands has recently published, the Netherlands has opted for this third rule, and it makes it easier for the Netherlands to tax local companies in its jurisdiction, to tax them extra if their ETR will be lower than 15%. So in short, Pillar 2 is now on the table in the EU, and I think lots of other countries will follow suit. Pillar 1 will take some extra time and will take effect expectantly also 2024, but the work is still in progress there.
Thank you, Max. So we have a few questions here in studio, because look at these puzzled faces. What do you think of this, guys?
Well, I have a question for Max. How do you think this will work out in a practical sense? I mean, there is no way this is going to work out, right? We are talking about multiple jurisdictions that will need to communicate with each other. And what do you think?
I think if you look at the Pillar 2 rules, they're a bit in line with the current country-by-country reporting rules. The country-by-country reporting rules prescribe that companies with a global turnover of 750 million yearly publish or draft a country-by-country report. And I think, it would be possible if you implement that with the Pillar 2 rules as well, that you have a good overview per jurisdiction, what their tax base will be in that jurisdiction. The thing is that I think the combination of Pillar 1 and 2 could be lots of more administration and work for multinational enterprises, and also for tax authorities in less developed countries. These rules are very difficult to understand, and for these authorities, I think it will be difficult to implement them.
So, Max, I've opened a poll right now in chat to see what people think. If Pillar 1, Pillar 2 is a good idea. It is a OECD-based thing, and I believe that for the Pillar 1, the $20 billion pillar, I believe that potentially 80 companies are in scope, right? 80. 80 companies are in scope. So perhaps that is, to visualize. Do we have from the Dutch government any anticipated revenue figures? Do we know how much they think this would add to the budget?
I don't have do not know the numbers by heart, but I do know that in the last 2 years, it was expected that these rules will generate a lot of more corporate income tax for the Dutch budget. But they now, after 2 years, that budget or the expected income by implementation of those both pillars will be much lower than eventually expected. So what you see is that it's more rules to ensure companies do what you like them to do, than just generating income for the government or for a budget.
Okay. Well, we have a poll result, and 100% of the votes, 2 pillars, good idea. You could choose nope, too complex, or yep, necessary. 100% of voters says yep, necessary. Now it's only a small batch, but still that goes to show. So that concludes Pillar 1, Pillar 2. Now we need to get Peter on the phone, because we want to zoom in on the Anti-Tax Avoidance Directive 3, because this is a effort, the global minimum tax rate, and a cross-border instrument to enforce it beyond just your national jurisdiction, is an effort to reduce CIT competition in rates but there's also a instrument to reduce CIT avoidance in through the use of shell entities, for instance. Hey, Peter.
Hey guys, what's up?
Nice Christmas tree, bruh.
Thanks, man. Thanks.
So the Anti-Tax Avoidance Directive 3, that is your little love baby, huh?
Yeah, sure. You can call it that. Let's just call it ATAD 3. It's ATAD 3, but I like to use the term ATAD. So just a very brief history on the anti-tax avoidance directives, plural. First, we had the ATAD 1, which was there were very many anti-abuse rules included in that directive. The Netherlands and all the other European countries, because this is a European directive, they already implemented this a long time ago. So I think 2015 or 16, the implementation date was due. So all of these rules you see that we have already implemented, or we already availed of those rules. So, for example, the third bullet from above in the ATAD 1 list is the GAR, the General Anti-Abuse Rule, and that is something that the Netherlands already had. Vrouwslegers, we call it. Also, there are some other rules regarding exit taxation. We already had those, but all of these rules, they generally try to increase the tax base of the Dutch company. If you regard it from a Dutch tax perspective, the Dutch company's tax base is increased if there's any abuse in the directive. ATAD2 or ATAD2 was more focused on hybrid mismatches and how those were exploited to gain a tax benefit. So before we go into that too deeply, maybe just switch to ATAD 3 because that is why we're here, and it's a lot of talked about. It's a lot of to talk about in just these few minutes. So ATAD 3 is a third directive in this sequence, and that is, as Bas already said, it's the Unshell directive, and it is aimed at the prevention of abuse for tax purposes of. Let's say empty shells or empty holding companies or empty flow-through entities. So again, a brief history of this specific directive. This all comes down to tax-induced abuse of let's say empty shells, special purpose vehicles, empty holding companies doing actually nothing but receiving dividends or interests or royalties and paying them on to their shareholders or other group companies. And for, let's say, from a Dutch tax perspective, the reason to have a Dutch entity within the structure was always that the Netherlands didn't, let's say up until recently, didn't levy any withholding taxes on royalties and interests. So that is why it was very beneficial in many structures to have a Dutch company inserted or interposed within the chain because the Netherlands could function as a backdoor out of Europe without any withholding taxes. So in essence, what I was just saying is this, but visualized. So the Dutch empty shell is interposed between two other entities within the chain, and in this case, there's, let's say, dividend payments from the subsidiary to the empty shell to the parent, and in a direct relationship with the subsidiary, the parent would have probably had to pay more tax on those dividends than it would have paid with the empty shell interposed. And that's always been, let's say, to use a Dutch expression, a thorn in the eye of the legislators, especially the left side of the political spectrum. They don't like the use of this, and to be fair, it kind of makes sense to want to combat this type of structuring. So if you go to the next slide, we can get a bit more into detail in how to this ATAD 3 directive works out. So there are five. It's a five-step approach essentially. First, there's the gateway. That is those are three cumulative criteria that you have to meet in order to be eligible for the empty shell qualification. So There has to be a lot of passive income. So a big chunk of your income has to be passive. And you have to have a lot of international activities. So that means that you essentially have to receive dividends or royalties or interest, and you have to pay them on to, let's say, a non-Dutch resident company. So that is the international part. So you have to receive it from a non-Dutch party, and you have to pay it to a non-Dutch party, either of the two. And your management is outsourced to a third party. And that essentially means that, well, for example, the trust sector. This is what happens to hit the trust office sector the hardest, because many countries, for the reasons I stated before, many companies want to insert a Dutch company into the structure. But if they do not have, let's say, local directors or at least local decision making in the Netherlands, then the company wouldn't be considered a Dutch tax resident for Dutch tax purposes. And so the treaty wouldn't apply. Therefore, it is always necessary to have the decisions of the company be made in the Netherlands, physically in the Netherlands. And that is where the trust offices came in. But now this directive aims to combat that, because they think it's too artificial. But then if you pass this gateway, if you check all of these 3 boxes, then you're in the hot seat. So you have to make sure that you can still escape from the sanctions of this directive. And there are 4 steps to have an escape, to form an escape. And first is a very hard, or let's say rigid carve out, and that is just it's a limited list of exclusions or carve outs of types of entities or structures that are not, let's say, sanctioned by this directive. So if you're a listed entity, for example, or a bank, then you're not in scope of this directive. So let's just move on to step 3 then, the substance reporting obligation. So let's say you've passed the gateway, you check all 3 checkboxes, you aren't carved out, and then you're in step 3, and you have to, with the submission of with the filing of your tax return, and we're still talking about the Dutch company here, you have to answer certain questions because you passed the gateway and you aren't carved out, and you have to answer those questions in all honesty. And if you answer them, well, let's say correctly, well, honestly is of course required, but if those answers satisfy certain criteria, then you're still escaped. Let's say that's an escape from the directive sanctions. So the major, criterion for this is that there is office space in the EU that is. Oh, boss, you have a question?
Yes, we have a question in chat. Deepak wants to know, is outsourcing finished when trust personnel is put on the payroll of the company?
If trust personnel is put on the payroll of the company, well, okay, so this is an interesting question. And as you can see, you wouldn't actually pass the gateway, because then in that case, your management is not outsourced. So in essence, I think it will be a way out if you put people on the payroll. But obviously, I'm not sure this directive. I think it's implemented. The implementation date is 2024, the 1st of January, and I don't think that this situation was provided for within the directive. But I can imagine that they would think that this is just a circumvention of these rules, and therefore that this is probably also covered. But in essence, if you're on the payroll, I think that's okay. If you don't outsource it, if it's all from your own payroll, then it should be fine. Maybe there is, maybe you probably just, or you probably will still be sanctioned by the directive if the payroll employees are not, let's say, full-time employees, if they are not FTEs, or if they're not 1 FTE per person. But if they're only, let's say, 0.1 FTE per person, then maybe in that case, it's too much like the trust setting. But I'm not sure. It's a good question. Haven't really thought about that. Might be a good escape. Yeah. So anyway, you're also carved out if you're a Dutch company with more than 5 active FTEs. So again, that is circling around the FTE aspect, and that means that if you want to circumvent this, and let's say that the escape that Deepak just mentioned or hypothesized, that if you were to put some employees on the payroll and it would be seen as abuse and it will be overridden by the directive, then you have to make sure that there's at least 5 or more than 5 active FTEs on the payroll. And of course, there will be a bit of too much of a, let's say, a wage burden and maybe administrative burden just for the sanction of this directive not to apply. So you have to jump through a lot of hoops in order to achieve that. But okay, so let's now assume that you're through the gateway, you aren't carved out, and that you answered all the questions in your with your tax return. You abided by the substance reporting obligations of step 3. And let's say that there is no office space at your exclusive disposition, or you don't have the equipped management or anything else of this list, then there's still a possibility to rebut the possibility that you're an empty shell. And you can do that by evidencing that there are commercial reasons to use the Dutch entity, to use the empty shell. And you have to provide some further information as well. But the main reason or the main point here is that you have to make plausible or make or evidence that you are not set up for only for fiscal or for tax purposes. And if that is not something that you cannot do, if you don't manage to do that, then you're an empty shell still. But then there's still a possibility to exempt yourself from the sanction of this directive, and that is if you can really evidence if there is no actual tax benefit. So in step 4, it's about the aim or the subjective element, and in step 5, it's to see whether there's objectively or in absolute sense a tax advantage that was gained. And if there's no tax advantage because maybe some other anti-abuse provisions apply and therefore there is no tax benefit for the Dutch entity in the structure, then this directive is not going to add to those sanctions, which makes sense. Matthew has a question, I think.
Peter, do you think this will kill the entire Dutch trust sector?
European.
Yeah, so it's what says is correct. So it's a European directive. All European countries have to implement this before, let's say, 1st of January 2024. But as for the Netherlands, I'm not sure whether this will kill it because I think the trust sector, especially when looking at the Holland, for example, the Holland Quest or Tax Integrity Directive. I think they're really looking to sort of refurbish themselves as not only wanting to facilitate tax avoidance or only look after to chase tax benefits, but I think there is a real change in their industry that is in effect coming down to facilitating the actual economic presence in the Netherlands. So I already see a change there, but I think that for the old traditional trust services that are mainly focused on getting a tax benefit, that maybe that is that can be reconsidered after implementation of this directive, because the sanctions, if you look at the right hand side, can be very burdensome for the companies, or at least for the structures, or for the structures of the to which the Dutch empty shell belongs. Because if you are sanctioned by this directive, then it's not the sanctions that hit the empty shell itself, but it's the parent company and the subsidiary company that are actually, hit by the sanctions. And also, if you fail to comply with the reporting obligations, the substance reporting obligations of step 3, then there is a fine of 5% of gross revenue, which is quite heavy. And I think even 2 years prison sentence is possible for the directors of the empty shell company.
So Peter, we're putting this to a vote, because one thing that I noticed too is that with 5 FTE or within a listed group, you can be exempt.
Yeah.
And it would seem that this may harm competition, right? Because if you have money enough, if you can pay 5 FTEs, then you can still treaty shop and you're exempt from the directive. And it's an easy calculation. How much do 5 FTEs cost and your lease? And how much of a percentage reduction in withholding tax do you get when you can effectively use the shell, but it's not empty for the directive? So I wanted to put it to a vote whether it is a good treaty shopper stopper or whether it's too easily circumvented.
Yeah.
For which I've led the witness already. But we will
Yeah,
see.
you're leading the witness, but it's okay. I really I understand where you're going, and that's always the risk of delineating too strictly the conditions for abuse. So if you have, let's say, an escape rope by way of a, let's say, number of FTEs, but they have to be active FTEs, right? So not too sure what active means in this sense. So might be that they have to be running an actual business enterprise instead of only watering the plants. But so that's always the risk, the downside of having very clear legislation.
Okay.
Obviously, not sure. What does the poll say?
The poll says nothing yet. Go vote. Your vote counts.
I voted.
Oh, well, now 100% says too easily circumvented.
Yeah.
Although, that's where you can see that one man can make a difference.
Yeah, but of course I have to add the caveat that that I'm not sure what the active element of the FTEs means. So it can be that it's not so easily circumvented. Regardless, the Danish cases is a court case of the European Union Court of Justice of 2019, and it was about Danish companies paying passive income to let's say Luxembourg companies and other companies, and the tax authorities of the Danish or the tax authorities of Denmark, they said that they wanted the interest and royalty directive to not apply, or at least that they could withhold withholding taxes on the royalty payments and interest payments. So they shouldn't have to apply the withholding exemptions provided for by the directive, because there is a certain, let's say, or a European beneficial ownership term, and that is when the Court of Justice of the European Union actually ruled that. They ruled two very important things. One of those things is that safe harbor rules are not they're not sacred. So if there's, let's say, a minimum substance requirement, and beyond that point there's no sanctions by, let's say, a directive, or beyond that point a certain directive benefit should be granted, then that is too rigid. You have to, as tax authorities, you have to look at all facts and circumstances before you can decide whether or not to grant the directive benefits. The same goes for the other side. So mechanical see-through or look-through approaches are not decisive in determining whether there is actual abuse. So if tax authorities want to be able to determine whether or not they can deny directive benefits, it is too simple if they could simply apply a look-through approach, as we saw in the visual a few slides back, and say, well, without this company interposed, this one, without the Dutch company interposed, there would have been more tax would have been levied. So therefore, it must be abusive. So that will be too short of analysis and too easy an analysis for them to determine that the structure is abusive. So in all cases, there has to be an analysis of all facts and circumstances. And in that regard, or in that light, you can maybe put some question marks with all the hard carve-outs and substance requirements that this directive proposes. I'm not sure how you look at that. Maybe Maybe
We'll
it's
see
all.
what the People's Court says. What do you think about Anti-Tax Avoidance Directive 3?
I think that it's a sign of the times. What I was wondering, Peter, is of course you mentioned that the Dutch government has implemented a withholding tax on royalties and interest. How favorable are the interposing Dutch BVs still in this tax climate?
Well, so your question is sort of twofold. And first, you mentioned the conditional withholding taxes on interest and royalty payments. So let's just first talk about the traditional aim of the interpositioning of Dutch companies in structures is to get treaty benefits, and the conditional withholding tax only applies in relation to, let's say, low tax jurisdictions with which the Netherlands, in principle, doesn't have any tax treaties. So,
I think it's important to know. So I was reading on the Tax Foundation platform today, and it turns out that 85% of global tax evasion, that or avoidance, I should say, that often involves arbitrage, does not involve what they called palm tree layered islands. 85% of it only has to do with developing nations, and within that, 55% has to do with Switzerland, Luxembourg, the Netherlands, and the UK. So, in a sense, the treaty shopping would need to be stopped, because you do, in essence, circumvent what governments seek to agree on with each other, because you really kind of create a bit of a most favored nation setup, right? If you can always just interject whatever treaty state you would want, and an entity would be enough, it's not a good look.
I agree. It is the let's say the principles behind this directive are so so they're easy to get behind. You know.
The question is then, I guess, has it worked?
That is the question, and it remains to be seen, I think. Maybe still too early.
I thank you, Peter, because we move on to the next chapter here, because this is a good starting point for other stuff that we look at, because much of this is this pertains to corporate income taxes, but as we've just discussed, and I think this is a point in case, it's only 9% of revenue, and we've already spent 45 minutes of a 1-hour webinar zooming in on corporate income tax, where I think in the future we're going to see many other taxes becoming much more relevant. And one of the things I anticipate on is the carbon taxes, and that's something that's recently come into play, and this was a major thing today. So in Europe, we already have the European emissions trading system, the ETS. And the way this works is any industrial installation gets free emission space. That's how much they may emit, and this drops on a yearly basis. And for anything in excess, they need to have purchased rights, so certificates. They need to hand those to the emissions authority, and if they have any more emissions and they don't have certificates, they have a deficit, and the deficit is there's a punitive sanction really on it. And some countries, they impose an additional domestic layer. The Netherlands is one example. And that is where we have the European Union sets the free emissions. But within the borders of the Netherlands, we have an accelerated drop in that free room. So this is the Netherlands it actually decreases the amount of emissions you can have quicker than Europe says you must, and that means you need more purchased rights if you are a Dutch company or you have a industrial installation within the Dutch borders. Then you need to put in your purchased rights, and if the market price for those purchased rights is below a certain point, then the delta is levied as a tax, and that means that there's effectively a minimum price on carbon emissions within the Netherlands. And that means that the stricter you are, the more enticing it becomes to shift your production elsewhere. And this is something that is known as carbon leakage. And carbon leakage, as soon as the European Union becomes more rigid in this, you can see where we had tax competition, we can also get carbon competition. And so in order to curtail carbon competition, the European Union has now just a week ago agreed on the carbon border adjustment mechanism, which is a tax that's going to be levied from importers of goods, and they need to evidence the amount of tax that was already paid for the emissions and the amount of emissions that was involved in the production of the good. And any delta between what they would have owed had the good been produced in the European Union and what they have paid is levied by the European Union. So they finally did it. They now have their own tax.
So it's kind of like a Pillar 2 approach.
In a sense, it is. Yes, there's always a minimum tax on any good that you want to bring to the European Union, and where even if you've produced it elsewhere. And I think if you look at the future, if we think back about the diversification of revenue, I think there's a lot of room here because we have a big bottleneck, and that's the labor market. And so we cannot really increase taxes on work. And that's a universal principle really now throughout the world. But I think emissions, maybe still there's lots of room because those largely go untaxed. And so those externalities aren't properly priced. And I think this is a trend that we're going to see more of. And I think there's another background to that because such a tax, a goods tax, is actually pretty simple in its application. And I think another point in case there is the fact that so many European countries have, being impatient for the Pillar 1 and Pillar 2 tax, have implemented digital service taxes themselves. And digital service taxes are levied from, well, large. They have a 750 million threshold usually too. And those are levied from the large software companies, which are generally from, America. United States. There's only a few companies, only a few software companies are so large. And you can think about Meta, you can think about Google, you can think about Facebook. And that means that many tax authorities are looking to tax those non-brick and mortar companies, but they're having a difficult time because we either need to update the fixed establishment definition or we need to come up with a formulaic approach to attribute profits to market rather than HQ jurisdictions, which is essentially what the Pillar 1 and Pillar 2 approach is doing. And the digital service tax is an alternative, but you could, it's a tax on a company that has no, necessarily does not have any offices within your border. And so you're pushing the bill outside of your borders. And not everyone will agree with this. So that's where we have another thing that I think is going to be the fireworks next year. That's where we have OECD versus United Nations, because some people say that the Pillar 1, Pillar 2 approach really is an effort by the United States to prevent digital service taxes, all sorts of individual digital service taxes from being implemented, and finding a bargaining chip where we have a common ground approach. And the OECD really is a network of developed rich nations. And this was put to a vote. The League of African Nations, they went to the United Nations and they said, we need to take captaincy in the public tax debate because we have been looking at the OECD do the BEPS project for the last 10 years. And the ATAD 1, 2, and 3 are logical products of it. And those we can get behind. But we are now coming to that 80-20% rule where we're going to spend 80% of our time on 20% of revenue, or a 9 actually. And it's starting to become increasingly complicated. And also it's a dishonest bargaining chip because we need to buy into the Pillar 1 and 2 approach by saying we will not implement digital service taxes, for instance. So it looks very inclusive, but in effect, many African nations are saying we don't much agree. And so that's when I kind of deep dove into this item that's actually quite interesting because, well, we have just looked at how a tax treaty works, right? Imagine there isn't a tax treaty, a Dutch company and a subsidiary in Chile. Imagine there's a loan with $1 million of interest and there's withholding tax at source at 35% in Chile, then even if the Netherlands would allow for a deduction, then there's still tax leakage. Whereas if you have a tax treaty that creates a complete prevention of double taxation, then you effectively only, the treaty only decides where you pay tax, but your effective tax charge is unaffected. And so tax treaties there have always been an important element, and those are actually the source of the OECD. So if we look at the first tax treaty, it was created by the League of Nations in 1928, and the League of Nations was incorporated because diplomats moved to different countries, and then sometimes diplomats had to pay taxes different from local residents because they're paid by foreign governments. So that too is a way of pushing part of your revenue onto foreign governments. And in order to make sure that wouldn't happen, they created a first tax treaty and said we're going to reconvene and we're going to expand this because we want more global business. This is actually a very useful instrument, the tax treaty. So we want to expand this to other sources of income, for instance, businesses going global. And so it happened in 1938. They said, we will reconvene in 1943. But then something happened in Europe, World War II, and many of the countries involved with the League of Nations couldn't make it. So there was a Latin American-centered draft, the Mexico City draft, and those are usually the capital importing countries, and they favor taxation at source. And that was the United Nations draft. Then in 1946, when the war was over in Europe, the European capital exporting countries reconvened and came up with the London draft. And they said, no, really, it is, we need a neutrality. So you tax all the revenues where the company is located and not where the revenue is from. And this, they never reconciled the difference. In 1946, the League of Nations was disbanded. The United Nations was started. And the OECD turned into a exclusive club that zoomed in on economic development. But the OECD, if we look at its member states, even today, you can see that there's a persistent underrepresentation of anything that basically isn't Europe, the Anglosphere, or a handful of South American countries. And the OECD, in the meantime, is the talk show host to many talks that far surpass that scope, because with the inclusive framework on Pillar 1 and Pillar 2, you are effectively taxing also a lot of African states and Asian states, and they really aren't a party to it. Yeah, they're invited to the talks, but they're not OECD member states. And so some people are saying this is a disingenuous chat. And so what are some of the difference that we see between the current day United Nations model draft and the OECD draft? You see that a PE threshold is lower. There's a force of attraction. If a company has revenue that isn't allocable to the persons working at the PE, it is taxable in the PE state still because of force of attraction. There's no deduction of internal royalties for the use of IP. You can only split development costs. There's a gravitation towards source withholding taxes, and there's even a withholding tax on services. So if we render advice to for instance, South Africa, they may levy 15% withholding tax on our invoice, even though we have no physical presence in South Africa, and it would be paid by our client. So in a way that is business unfriendly, and it does create a better allocation to market jurisdictions. And I think that going forward, we're going to see a lot of movement here, because Pillar 1, Pillar 2, if you ask me, gentlemen, really that is, we have hit the end of it right there, right? We have kind of seen that things are getting highly complex now with Pillar 1 and Pillar 2. We are seeing that corporate income tax is not so important. We are seeing that many countries are actually unheard. What are your thoughts on this? What are we seeing for the future, for 2023?
Well, I think equity is a broader theme that's rapidly gaining attention and gaining ground. And yeah, you can see it everywhere, that the the economic dominance of the West is decreasing, such as China becoming more and more economically involved. And the worldwide equity is being a more important topic than it has been, well, ever. So I think it's just in the line of expectation that the economic and tax framework would adjust to that sentiment as time progresses. So yeah, totally agree with this development, and I think that if the development is being kept alive and kept pushing, then this could gain ground really quickly.
I guess with that, we may conclude that we are going to see a shift from a corporate income tax focus to maybe a goods and emissions focus, and maybe the leakage potential can be taken away by making international efforts. And perhaps the best platform for that isn't the OECD, but the United Nations. So maybe 2023 is the year where we see focus being shifted from corporate income tax to emissions and goods, and we see captaincy shifting from OECD to the United Nations. OECD and its nations are, even though they adopted the resolution, are still kind of lobbying against it. They're saying we've put in so much legwork, it's a shame to walk away from it now. But all I can say is that we must see what it brings in 2023, because, with this, we leave you for this year. I think that 2022 was most interesting. Yet again, we will see what 2023 brings. And for now, we wish everyone fantastic holidays. And all the best to you. Peter, our viewers have a good 2023.
I'm driving home for Christmas. Oh,
Happy
I
holidays,
can't wait
everyone.
to see those faces.